What if I told you that the IRS, the same agency that takes money from you every single year, actually has a system in place where they will pay you to invest your own money? Not a rumor, not a loophole that could get you in trouble. This is completely legal, fully approved by the federal government, and specifically designed to benefit people just like you. But here's the shocking part. The majority of seniors in America have absolutely no idea this exists. And every single year they do not use it, they are leaving real money on the table. Stay with me for the next few minutes because what I am about to share with you could change the way you look at your retirement finances forever. Welcome back to Rule by Seniors, the channel that exists for one reason and one reason only: to make sure you keep more of your hard-earned money in retirement. If you are new here, welcome to the family and we are so glad you found us. Please subscribe to Rule by Seniors right now, hit that like button, and tap the bell icon so you never miss a video. We publish content every single week that is designed specifically for seniors, covering Social Security, Medicare, taxes, benefits, and financial strategies that the mainstream media simply does not talk about enough. This community is growing every day because the information here is real, it is relevant, and it works. So subscribe right now and let us get into something that could genuinely put more money in your pocket starting today. The IRS tax code is hundreds of thousands of pages long. Most people never read it. Most people never have to. But buried inside that enormous document are incentives, real financial incentives, that the government has created specifically to encourage certain types of investments. And for seniors, these incentives are incredibly powerful. We are talking about situations where the government will essentially reward you with tax credits, tax deductions, and in some cases direct financial benefits simply for putting your money in the right places. This is not about being sneaky or finding gray areas. This is about understanding the system well enough to use it the way it was designed to be used. Let us start with the most powerful one, the Retirement Savings Contributions Credit, also known as the Saver's Credit. This is a tax credit, not a deduction, but an actual credit that the IRS gives you for contributing to a qualified retirement account. The difference between a deduction and a credit is enormous. A deduction reduces the income you are taxed on. A credit reduces the actual tax you owe dollar for dollar. The Saver's Credit can be worth up to $1,000 for individuals and up to $2,000 for married couples filing jointly. If you contribute to a traditional IRA, a Roth IRA, a 401k, a 403b, or several other qualified retirement plans, you may be eligible for this credit based on your income level. For seniors who are still working part-time or who have modest retirement income, this credit can be a genuine game changer. The IRS is literally giving you money back for investing in your own future. Now let us talk about traditional IRA contributions and the tax deduction that comes with them. When you contribute money to a traditional IRA, that contribution may be fully deductible from your taxable income depending on your income level and whether you or your spouse has a workplace retirement plan. What this means in practical terms is that the money you put into your IRA reduces the amount of income the IRS can tax you on. If you are in a 22% tax bracket and you contribute $6,000 to a traditional IRA, you could reduce your tax bill by over $1,000. The IRS is not directly handing you cash, but they are telling you, invest this money for your retirement and we will take less from you right now. That is as close to being paid to invest as it gets. For seniors who are 50 years of age or older, there is an additional benefit called the catch-up contribution. The standard IRA contribution limit for most people is $7,000 per year as of recent tax years. But if you are 50 or older, you're allowed to contribute an extra $1,000 on top of that, bringing your total to $8,000 per year. For 401k plans, the catch-up contribution is even more significant. The standard limit is over $20,000 per year, and seniors 50 and older can add an additional $7,500 on top of that. The IRS created these catch-up provisions specifically because they recognize that many people arrive at their later working years without enough saved for retirement. This is the government giving older Americans a specific advantage, a larger window to invest more and receive more in tax benefits. If you are not taking full advantage of catch-up contributions, you are walking away from free money. Let us talk about health savings accounts, or HSAs, because this is one of the most powerful and most misunderstood investment vehicles available to seniors who are still covered by a high deductible health plan. An HSA gives you what financial experts call a triple tax advantage. First, contributions you make to an HSA are tax deductible, meaning they reduce your taxable income just like a traditional IRA contribution. Second, the money inside an HSA grows completely tax-free. Any interest, dividends, or investment gains inside your HSA are never taxed as long as the money stays in the account. Third, withdrawals from an HSA are completely tax-free when used for qualified medical expenses. No other investment account in the entire tax code gives you all three of these benefits at the same time. For seniors who are approaching Medicare age or who are dealing with rising healthcare costs, an HSA is not just a savings account. It is one of the smartest investments available. The IRS is rewarding you on the way in, on the way through, and on the way out. Now here's something that not enough seniors know about: qualified opportunity zone investments. The federal government has designated certain economically distressed areas across the country as opportunity zones. When you invest capital gains money into a qualified opportunity zone fund, the IRS gives you significant tax benefits in return. You can defer paying taxes on those capital gains, potentially reduce the amount of capital gains tax you ultimately owe, and if you hold the investment long enough, any new gains generated by the opportunity zone investment itself can become completely tax-free. This was created by the Tax Cuts and Jobs Act specifically to encourage investment in communities that need it. And in exchange, the government gives investors powerful tax incentives. For seniors who have sold a property, a business, or other assets and are sitting on capital gains, this is an investment strategy worth discussing seriously with a financial advisor. Let us also discuss municipal bonds, because this is a classic investment that the IRS essentially subsidizes without most people realizing it. When you purchase a municipal bond, which is essentially lending money to a state or local government, the interest income you earn on that bond is typically exempt from federal income tax. In many states, it is also exempt from state and local income tax. What this means is that while a regular bond or savings account forces you to pay taxes on the interest you earn, a municipal bond lets you keep every single dollar of interest without giving any of it to the IRS. For seniors in higher tax brackets, the effective return on a municipal bond can actually be higher than a taxable bond with a greater stated interest rate once you factor in the tax savings. The government is saying, lend your money to help fund roads, schools, and public projects, and we will not tax your earnings. That is a direct financial benefit for investing. Another area where the IRS rewards seniors specifically is through the tax treatment of Roth IRA withdrawals. If you contributed to a Roth IRA during your working years, or if you convert a traditional IRA to a Roth, the money inside that account grows completely tax-free, and qualified withdrawals in retirement are 100% tax-free. You will never pay a single dollar of income tax on the growth inside a Roth IRA as long as you follow the rules. For seniors who are managing their income in retirement to stay below certain thresholds, for Social Security taxation, Medicare premium surcharges, or other income-based programs, having a source of completely tax-free income from a Roth IRA is an incredibly powerful tool. The IRS is rewarding you for having paid taxes upfront by giving you total tax freedom on all future growth. Let us also address the senior tax credit directly. Officially called the Credit for the Elderly or Disabled, this is a tax credit that the IRS makes available to people who are 65 or older, or who retired on permanent disability. Depending on your filing status and income, this credit can be worth between $3,750 and $7,500 in terms of the base amount it is calculated on. This credit directly reduces what you owe the IRS, and it exists specifically because the government recognizes that seniors deserve a financial break. Many seniors never claim this credit simply because they did not know it existed. If you are 65 or older and you are filing a tax return, ask your tax preparer or check IRS Schedule R to see if you qualify. Here's something you need to understand about all of these strategies. They only work if you know about them, and they only benefit you if you take action. The IRS does not send you a letter reminding you to claim your credits. They do not call you and say, hey, you left money on the table this year. It is entirely up to you to know what you are entitled to and to make sure you claim it. That is exactly why channels like Rule by Seniors exist, because this information should not be a secret, and no senior should be losing money simply because nobody told them the rules. Before you do anything else, sit down and review your current investment accounts. Look at whether you are contributing to an IRA, a 401k, or an HSA. Find out if you are taking advantage of catch-up contributions. Check whether you qualify for the Saver's Credit or the Senior Tax Credit. If you have capital gains sitting in a taxable account, speak with a financial advisor about Opportunity Zone investments or municipal bonds. And most importantly, make sure you are working with a tax professional who understands the specific rules that apply to seniors, because the strategies available to you are different from what applies to a 30-year-old, and you deserve advice that is tailored to your situation. The government has built these incentives into the tax code for a reason. They want seniors to invest, to save, and to build financial security in retirement. And in exchange, they are willing to reduce your taxes, give you credits, and in some very real ways pay you to make smart financial decisions. The only question is whether you are going to take advantage of what is already available to you. If this video gave you value today, please give it a thumbs up right now. It takes 1 second, and it helps this information reach more seniors who need it. Share this video with someone you care about, a spouse, a sibling, a friend, anyone who is in or approaching retirement. And if you're not yet part of our community, subscribe to Rule by Seniors right now and hit that bell so you get notified every time we post. We are here every week fighting for your financial future. Thank you so much for watching, and we will see you in the next video.